All right, so we'll continue our introduction of the Farmer-French three-factor model. So remember, what we're doing is we are testing whether the CAPM formula holds. The CAPM formula says that the excess return of any stock depends on beta times the market excess return, and beta is the correlation with market. Now, practically testing CAPM means testing whether this equation holds. So the focus is usually on whether there is an excess return that is abnormal, alpha. So you get a very nice linear equation that you can test. The excess return of a particular stock equals to alpha term plus beta times the market excess return. CAPM says alpha should be 0. And what we're going to test is whether that's actually so. Graphically, I've shown you this diagram before. This is for Japanese stocks. And you can see that typically stocks with high book-to-market value, high cash flow, high earnings to price, and small in size have particularly high return. Even more so, stocks that I would say are you probably consider weird, right? Those with negative book-to-market or zero book-to-market value, negative cash flow, negative earnings have the highest return. So there's something very interesting here that is not predicted by CAPM. Okay. So we're going to focus on the fact that low market value stocks, which we call small caps, high book-to-market stocks, which we call value stocks, and high earning yields and high cash flow yield stocks are outperforming the CAPM prediction. So, as we mentioned before, the linear relationship predicted by CAPM makes it very good to test with simple ORS. Mostly what you need to do is to correct for serial correlation, make sure your data actually line up correctly, and then you can test whatever effect you want. And we also mentioned that in older papers, it's common to calculate beta and test for whether the excess return is significant or not. The reason that is done in the past is that beta is actually more accurately estimated. The correlation is can be better estimated, and so that's what they did in the past. Right. So Farmer-French from 1992. This is as suggested in the previous slide, basically adding factors that you might think would affect return into an ORS regression, corrected for serial correlation. So what do we see? Now, okay. First, beta's coefficient is not statistically significant. The number in the bracket is T statistics. So this is different from the standard economics paper, which usually reports standard errors in the bracket. So in economics paper, typically, the smaller the number in the bracket is, the more significant the results are. But in finance, typically the bigger the number inside the bracket, the better, because it's a T-stat. So beta has on its own have a T-stat of 0.46, which is way below significance. Size on its own have a T-stat of negative 2.58, which is very significant, right? The estimated effect is negative 0.15, so that's a 0.15% effect on individual excess return on average. So it's negative, meaning that the bigger the size, the smaller the excess return is. And notice that this is log, right? This is log. So when in a regression, when you put in a log term, it becomes a percentage change, right? So this gives you a very nice interpretation. A 1% increase in market capitalization gives you a negative 0.15% change in excess return on average. Book to market, the most significant of all, a 0.5 effect. So that means a 1% higher book to market value would lead to a 0.5% higher excess return on average. There are also positive effects on the other items, including measure of assets, earnings, and overprice, and so on, as you see in the fourth and fifth line. When you put everything together, in the second to last and the last rows, you see that the earning over price
So it's important to note that CAPM, that the small cap stocks and value stocks are having abnormal return under CAPM, which is a very simple model. You have to make a lot of assumptions to get a CAPM. So maybe a more sophisticated model perhaps. So and the idea is value stocks and small cap stocks are each exposed to common factors not shared by growth and large cap stocks. So the idea is, why would a company have high book to market ratio? One way of seeing that is that the market is discounting what is shown on the books. So if you believe the market is efficient, then there must be some risk involved that is not indicated by the book value. So the market discounts the book value, which leads to a lower book to market, which leads to a lower market value and a higher book to market ratio. Similarly, small stocks are probably newer companies, so they have higher risk. So that's the idea. And Farmer Friend from 1993 attempts to construct two indices that captures these factors. So it's constructed from data in the following way. Okay, so the original Farmer Friend's three-factor model used US stocks, and their model is actually quite straightforward. Instead of just a single factor, namely the market excess return, they added in a small minus big factor and a high minus low factor. So small minus low, high minus, small minus big, high minus low. These two factors capture respectively the small cap effect and the value stock effect. And the factors are calculated as follows. The stocks in the United States are separate first into two groups, two equal groups based on size. Now, practically, the split was done with New York Stock Exchange only, and the stocks in the other exchange are sorted into the cutoff accordingly. If you're doing Farmer Friend in Hong Kong, then you don't have that problem because we only have one stock exchange. So you separate all stocks into two groups, equal size. That's the first step. Then separately, in the second step, you separate all stocks into three groups. You separate all stocks into three groups of equal size. That's the low group, medium group, and high group. this gives you 6 groups of stocks. Small minus big is the average of the top 3 minus the average of the bottom 3. So it's a simple average. 1/3, 1/3, 1/3. It's not value weighted. It's 1/3, 1/3, 1/3. So it's a simple average. So simply you add the first, the second, and the third term together, divide by 3, minus the fourth, fifth, and sixth term, add together, divide by 3. So it's a simple average. Similarly, high minus low is the right 2 terms, minus the simple average of the right 2 terms, minus the simple average of the left 2 terms. Okay. So it's very straightforward calculation, assuming that you have market equity and book to market ratios at hand. So the up-to-date data for US and for some international markets can be downloaded from Canny French website, so you don't need to calculate them yourself. And it's also available on WRDS. All right, so now in the assignment, you'll see an exercise that asks you to sort stocks into groups, into these groups. Wait a minute, did I? Oh no, it's okay. I did not. Okay, that's fine. All right, there's something that you would want to note in particular when we're talking about Farmer French, and that is, well, what? So you have stock prices usually for every month. For Farmer French, usually it's calculated monthly, not daily. It's calculated monthly. So at a given month, what market equity do you want to use, and what book to market ratio do you want to use? Now this is not a trivial question, because if you said, let's say, for data in, let's say, a particular year like 2005, so you have stock prices for every month in 2005. If you simply use the book market ratio for 2005, that is likely incorrect. In January of 2005, the investors likely do not have access to the book to market value of 2005, right? That's it, because book to market ratios are released in financial statements, and these financial statement for the fiscal year covering 2005 is most likely not available on January 2005. So we have to be very careful in what accounting information we use because of this reason. Similarly, for market capitalization, it's basically stock price multiplied by shares outstanding. You also want to be careful whether the information about the size is recognized by the investors or not. So typically, in calculating, merging these fundamentals to stock prices, we usually add in a lag. That is, when we're talking about stock price today, we use accounting information at least a few months old. In the case of Farmer French, the accounting data is at least 6 months old before they are merged into a particular stock price. So in the assignment, you will see the actual quote in their paper and asking you to pick which date should merge to another. So you see it's stated quite clearly. Okay. All right. So this is where we were last time. Is how well does Pharma French do? Okay, how well does Pharma French do? So the way that Pharma French tests their model is that they sort all stocks into 25 groups. They separate all stocks first by size into 5 groups and separately by book to market ratio into 5 groups. So this is just a similar bucketing as in calculation of the factors, but then you have more groups. And you can see in this case that stocks on the left versus the stocks on the right. So you can see that the stocks with high book to market ratio have much bigger alphas. So they have a lot more returns that cannot be explained by CAPM. Right? Similarly, you can see that towards the right hand side, smaller stocks tends to have higher alphas than big stocks. So once again, they have returns that cannot be explained by CAPM. Once you use Pharma French, it takes away a lot of these effects, so alpha becomes much smaller and mostly statistically insignificant. Right? So the model works quite well empirically. It works quite well empirically. So the model works great, but what does the factors actually represent? So if you are an efficient market believer, like you would be if you're Eugene Pharma, then the factors represent risk. But if you are an inefficient market believer, you believe it's possible to pick stocks, then the factors should represent mistakes made by investors. So to take the efficient market route, you first have to face the difficulty of how to quantify what risk the factors represent. What are the risks? So it's not clearly not exposure to market risk, right? Because that's beta. What risk are we talking about when we have this small cap effect and high book and this value effect? What are we talking about? So one way of trying to figure out this problem is whatever the risks they are, they should show up in form of lower return in some periods of time, right? By the definition of risk, stock price have to be lower at some point. Otherwise, it's not risk. Okay? So Leconskock, LE. So 1994. So this is a contrary investment, extrapolation and risk, Journal of Finance article. So what they did is that they calculate year-by-year returns of value minus gambler stock portfolios. So what does that mean? The value stocks portfolio is the top 30% stocks based on cash flow to price and bottom 30% based on growth in sales. Okay, so high cash flow and low growth in sales. Glamour stocks, low cash flow, high growth in sales. Okay. All right. Sorry. So you can imagine that. The value stocks are somewhat boring stocks, right? They generate a lot of cash relative to their price, but they are not growing a lot. So they're not growing. So it's kind of boring stocks. Okay, so that's why it's called value. And now the bars represent the difference between value stocks and glamour stocks throughout the years. And what do you see? Notice that the bars are mostly in the positive regions and rarely in the negative regions. In fact, there are only 3 years. There are 3 years in this duration that they are in the negative region. So how often do glamour stocks outperform value ones? Rarely, right? Rarely. So if this value effect is risk, it's certainly not manifesting itself here, because we're talking in 20 years. In 20 years, value stocks outperform granular stocks in 17. So in terms of the usual duration of investment, it seems like buying a value stock would always be a good idea. What about book to market and earnings per share? So in contrast to Pharma French paper, in this paper they found that book to market and earnings over price are not significant once you control for cash flow and growth in sales. So the details of regression matters. Sometimes you get one being significant, sometimes you get another being significant. Right. Okay, Daniel and Titman, 1997, Journal of Finance. Right. So if the factors represent risk, we should see higher return for assets that are more correlated with the factors, right? It's all about exposure. Just as stocks more exposed to market risk would have higher return, so you would expect stocks that are more exposed to these small stock factors and value stock factors should have higher return, because they're more correlated with some risk. And if you're more correlated with some risk, you should have higher return. This should be true even within each book to market sorted portfolio. So just in Pharma French, they sort stocks by book to market. Within each these portfolio, you should still see correlation between the stock's exposure to these factors. So once again, just like in Pharma French, sort stocks based on book to market size, and then correlate, and then also sort them with correlation with the high minus low factor. And once again, it's similar, 1 equals 1% excess return. All right, let's see what we get. Now notice that this table is more complicated than the ones before, because instead of just having a 2-dimensional sort, you have actually having a 3-dimensional sort, right? You have things like you have 3 groups for book to market, 3 groups for size, and then you have an additional dimension of the factor loading, the correlation with factors. Right. So let's just focus on the average. Let's just focus on the average. Right. So notice that as you become more correlated with the high minus low factor within any given portfolio, as you become more correlated with the factor, return does not seem to be going up, right? So if this is truly about risk, then if a particular stock is more exposed to this risk, investors should demand a higher return. Otherwise, they should just switch to stocks with lower exposure, and they can get the same return on average with lower risk. So the only way that in the market that the risk that investors would buy stocks that are exposed to a particular risk is that the stock provides higher return. But we are not seeing that here. More correlated stocks in generally do not get a much higher return. So this makes this risk factor argument harder to believe in, because that doesn't seem to be responding at all. Okay. All right. So there's no evidence that Pharma French factor represents systematic risk. It doesn't mean that it cannot be, it's just that the evidence is not going for it. So the baseline is Pharma French is an empirical model. So financial economists have discovered this pattern that small stocks and value stocks have particularly high return on average. They have developed a model that captures the effect very well, but whether it's because of some underlying risks or whether it's because of investor mistakes, it's hard to tell. All right, now we have mentioned the two biggest anomalies, well recognized, the value effect and the size effect. The next one I'm going to mention is momentum. Momentum is the notion that stocks have done well over the past 3 months to a year, have high subsequent return. So if a stock has been doing well within the past year, chances are they're going to do well next year. Obviously, this is all on average. If you pick a single stock, there's a high chance that this is not going to happen. But if you pick a portfolio of stocks that have all been doing well in the past year, then chances are, on average, your portfolio will do well in the next year. Reversal is the idea that, well, stocks have done in the past 1 to 4 years, so over 1 year, they have been doing well for quite some time. Then eventually they start earning lower return. So that's called reversal. So how are we going to test this? As I mentioned, one way you can do that is to actually pick stocks that have been doing well in the past and then construct a portfolio containing those stocks, hold them, and see what happens. So generally, the idea of testing a trading rule by portfolio formation is form a portfolio based on the trading rule, calculate the portfolio's excess return, compare this portfolio excess return to some benchmark, and for long portfolios, for portfolios that you hold stock, then the benchmark is usually a market performance measure. For example, for simplicity, you can use something like S&P 500. To be very accurate, you probably should use a value weighted average of the whole market. But then S&P 500 is very often good enough. So, for example, let's say you are buying the top 10% stock, then this would be what you would want to do. However, this idea of using a market benchmark is not necessarily what you want, because now a positive estimated effect means that the portfolio return is higher than the market. So your portfolio is doing better than the market, but if the market is doing very poorly, then the overall return may still be negative. So this is a problem faced by the index following funds, right? If you're index tracking, and you're comparing yourself to an index, then you could outperform the index. But if the index is doing very poorly, then you could also be doing very poorly. So hedge funds like this idea of market neutral portfolio. So in other words, the money you spend in buying stocks is offset by the money you spend in short selling stocks. So that's so theoretically, in total, you spend no money, right? You short sell stocks, meaning you sell stocks that you do not have, and you plan to buy them back later on, hoping that the price have gone down. So you are essentially borrowing money, right? You use the money to buy stocks. That would be a long short strategy. So that's called market neutral. So the benchmark in that case would be 0%, because what you're doing is you are starting out with no money, right? You don't have a positive or negative position on average. So the benchmark would be 0, doing nothing. And hedge funds would love to show that they can generate positive returns from market neutral strategies. Market neutral strategy is not easy to do in Hong Kong, because in Hong Kong, you know that if you are familiar with the Hong Kong stock market, there is a approved list of shortable stocks. You cannot short anything you want. Furthermore, the actual mechanism of shorting stocks involves borrowing stocks and selling them. So you're selling stocks that you do not have. How do you do that? That typically involves borrowing stocks from someone else and selling them. Now, who is willing to lend stocks? In the United States, even individual investors can short sell stocks. That's because there are sufficient number of large funds that are willing to lend stocks. Typically funds like pension funds. They hold stocks for long term, so they do not plan to sell their stocks in any short term duration. Since they plan to hold them anyway, they're willing to lend them to you because you have to return the stocks eventually, and they get interest in lending you stocks. So to them, given that they're already holding their stocks for long term, there's very little downside in lending stocks to you. In Hong Kong, it's difficult to find someone who is willing to lend to small investors. So it's typically very hard to construct a market neutral portfolio by yourself in Hong Kong. So an example of a market neutral portfolio will be longing the top 10% stocks that have gained in the most value and short the bottom 10%. To be truly market neutral, you should be buying stocks within the same sector, right? So for example, if you want to be, you have a market neutral portfolio in energy, then you'll be buying the best performing energy stocks and shorting what you think would be the worst performing energy stocks. This is market neutral because by buying stocks within the same sector, you're insulating yourself from the systematic risk within that sector, right? So you have cancelled out the risk in that sector by buying and selling stocks within that sector at the same time. And all your profit would be coming from picking the better performing ones. So a positive estimated effect represents money made out of thin air. So obviously it's not an easy thing to do. Hedge funds' performance are not particularly good in recent years. It's not easy. Right. So what is something that I mentioned last week is, now suppose we discovered a rule based on some stock data. Can we just compare the portfolio to the benchmark using the same data? And the answer is no, because you would be suffering from hindsight bias. If you have the benefit of foresight, you can always find a rule that would be profitable, right? The simplest profitable rule would be pick the stocks that have done well on hindsight. That's a sure win portfolio. The problem is you do not have the benefit of hindsight when you're actually investing. So to be a realistic portfolio testing method, you would need to do out of sample tests. That is, you separate your data into multiple parts, usually 2. You use the first part to formulate your rule and use the second part to test your rule. This is what you need to do in the assignment. This technique is also very important in data mining. In any data mining application, you have to do out of sample tests. Alright, so Jagadesh and Titman, 1993, Journal of Finance, return to buying winners and selling losers, implication for stock market efficiency. So this is a paper that focuses on momentum. Alright, so the portfolio are formed as follows. In every month, you buy stocks with the highest return in the past 6 months, and you short sell stocks with the lowest return in the past 6 months. So that gives you a long short portfolio. What do you get? So these are the average monthly return based on this strategy. Once again, the numbers within the brackets are T statistics. So the first month is slightly negative, but it's not significant. Starting from the second month all the way to the 12th month, the returns are positive. The returns are positive. Notice, and statistically significant, as you see, the T-stacks are already big, except towards the end, they get smaller towards the last 3 months. These are raw returns because because supposedly you're constructing a market neutral portfolio, so you do not need to consider all the risk factors in this exercise. So you see that there's some addition, so there is some positive return over time, right? So 0.01, 0.01, and so on, so on, so on. But as you get past the 1 year line, the return becomes negative, and as you move forward, none of them are particularly significant except the 18th one, right? A lot of them are, the t-stacks are actually quite small, right? So, but they are all negative. So even though any particular month is not particularly statistical significance, you do observe that a lot of them are negative. As a strategy in a whole, notice that the cumulative return from holding this long short portfolio, the cumulative return is significantly positive up to about the 23rd to 22nd to 23rd month. Beyond the so if you hold your stocks for 2 years based on a momentum strategy, your return would be, the cumulative return would be statistically indifferent from zero. Within 2 years though, then it's still, the cumulative return is still statistically significant. Now, this would be a good reason why looking at diagrams, actually stock diagrams, would actually make sense. So, technical analysis. They make sense because when you look at diagrams, you're pretty much looking at momentum and reversal, right? You're trying to figure out whether a stock is going to keep going up or whether it's going to turn back down. Given the existence of momentum, you would expect people who are looking for trends would actually profit, especially when investors engaging in technical analysis usually invest in short durations, right? No one picks stocks based on technical analysis and plan to hold them for 10 years. Typically, when you're doing technical analysis, you typically hold them. A few months is already very long. People very often hold them overnight or even just day trade. So for that reason, given that momentum exists in short durations, then it's actually support for why technical analysis actually brings in profit. So, momentum and reversal presents us with this same issue, namely predictability. As an investor, if you know there is momentum, then you get yourself a sure-win strategy by buying a portfolio of winning stocks and short selling a portfolio of losing stocks. So, if everyone is doing that, wouldn't that drive up the price of the winning stocks, drive down the price of the selling stocks, and balancing this effect out, resulting in no opportunity to profit? That's how efficient markets should work, right? If everyone wants it, the price goes up, eliminating any chance of profit in excess of the average. So, what's happening? Now, to answer this question, you need a theoretical model, right? You need a model to explain why the empirical observation that momentum exists actually occur in an environment with rational investors. Right, so we're going to do a graphical. I'm going to draw a diagram of a model of news watchers and momentum trader based on Hong and Stern, a unified theory of underreaction, momentum trading, and overreaction in asset markets in Journal of Finance. This model is very often quoted in empirical papers whenever momentum is concerned. The actual mathematics is quite complicated, but the graphical representation is actually not. So the model has infinite periods. There's one group of news watcher. So it's normalized to 1. But you should think about it as representing one group. Multiple momentum traders. And then I'm going to explain what they do in a moment. There's one unit of stock, and we assume the risk-free rate is 0 for simplicity. All right. So the model works in the following way. So news watchers receive news about the value of stocks slowly until the news is completely known. So information does not go public all at once. Instead, you hear about something, I hear about something, and slowly information descends among us until everyone knows about it. So what does that mean for the demand for stocks? The demand for stocks would increase gradually with good news and decrease gradually with bad news, right? As more and more people hear about it, more and more people would buy it, want to buy the stocks that have good news, and more people want to sell the stocks with bad news. So the assumption that news spreads slowly gives us a reason why stock price goes up and down gradually. So that's momentum. So momentum comes from news spreading slowly. We will assume that the news watchers hold stocks forever. Well, once again, this is a theoretical model. When you assume people hold stocks forever, it makes the analysis a lot simpler. But in reality, you should think about them as holding them for the long term. Right? What about the momentum traders? Momentum traders' demand increases when the stock price goes up. So as the name suggests, these investors are trend chasers. When the stock price is going up, they want to buy the stock. When the price is going down, they want to sell the stock. So what does that do? Now, we assume that they stay in the market for a fixed number of periods, and each period, the oldest momentum trader exits the market, and a new trader enters. Right? That captures the idea that momentum traders are typically short-term traders. And once again, what does that do to the market? Think about it. The underlying stock has the good news. So that's spreading slowly. It's spreading. Let's say it's spreading on my left-hand side, right? Slowly, we have 1, 2, then 3, then 4 investors buying because they heard the good news. And let's say on the right of this room are momentum traders, and you're basically looking at what the news traders are doing, the news watchers are doing. You see that they are buying. The stock price is going up. What will you do? Well, you follow the trend and you buy. What you're doing is you are exacerbating the effect, right? You are exacerbating the effect. When the news watchers buy, the momentum traders push the price up further. And similarly, if the news watchers are selling, the momentum traders push the price down further. All right? Then, when the news finally spread to all the news watchers, when everyone knows of the news, what happens? Well, the demand from news watchers would no longer increase because everyone who wants to buy have already purchased the stocks. What happens to the momentum traders? Now this is where the assumption that the momentum traders have short duration matters, because the new momentum traders comes into the market and realize that the demand is no longer rising, right? So towards the end, you look at the left hand side of the room, and you realize that no one is buying anymore. So as a momentum trader, you're not buying either. You are tracing the trend. At the same time, the old momentum trader would eventually exit the market, and they need to liquidate their stocks. What does that do to the market? When you have investors who want to liquidate their stocks, but there's not an equal amount of demand for the stock, the price has to go down. So that gives you reversal. So the reversal comes from momentum traders exacerbating the movement of stocks and ultimately leading to a reversal. Right? So the crucial assumption is each momentum trader's demand depends only on the price movement when they enter the market. If they are all looking the whole time series, then it would be very hard for them to start buying towards the end, right? Because they look at the whole trend, it keeps going up, so then you still want to buy. So the assumption is they only look at the movement at the time of the enter, when they enter. Right. So here is how the model should be drawn. So to draw the model, first we need news watchers gradually pushing price up. Second, the momentum traders see the price increasing and pushing price up further. Third, news watchers starts pushing price up after the good news is fully known. So at that point, the price should become stable. And then if at some point, existing momentum traders still have high demand, but new traders have low demand, but they would eventually exit. So the price should go back down. Okay, so we're going to use these 5 points to draw a diagram. Okay. All right. So how should the diagram look like? So I will start by drawing the news watchers. And let me make sure that I didn't actually have a diagram here. I do. Wow. Okay. So suppose there is a good news at time 0 that's spreading slowly. I believe the reason why I've already drawn it in PowerPoint is that in the past, before I have a Surface tablet, I have to rely on these monitors, and they are very unreliable. The pen more often does not work than they do. So I decide to just put the diagram in. So at time 0, there is a good news spreading. Stock price gradually goes up as the news spread to more people. At a certain point, the information has been fully revealed. So demand from news watchers flattens out. And since we assume they hold the stocks forever, it won't go back down either. All right. Then what happens with momentum traders? The momentum traders look at the stock price movement and they say, oh, it's going up, let me buy, so that they push up the demand. It's still moving up, let us buy. So the price, and then once again, they push up the stock price further, buy, until the point where the information is fully revealed. At that point, stock price start moving further up, right? Because the movement at that point becomes flat. Then, as investors, as the momentum traders exit the market, stock prices go down to absorb the stocks they are selling. So it goes down, eventually reaching back to what it should be. So this gives you the momentum and reversal. Momentum fundamentally is driven by information spreading slowly, and reversal due to momentum traders exiting the market. Right. So what do I have next? So price increase signal good news not yet fully incorporated into price. That's the rational part of price increase. Momentum traders push price more myopically. This is a price increase that is irrational, so reversal is inevitable. So model implication is consistent with short-term momentum and long-term reversal. Right. Okay, let's see about this one. Stock price reaction to news and no news, drift and reversal after headlines. Right, so what does this paper looks into? Now, remember in the Gigadesh and Titman paper, it's not about investigating the underlying reason of momentum. It's just showing you there is momentum, right? And then I show you a model that suggests that momentum is all about news. So we can test that, right? You can look into database of news articles, calculate the number of articles mentioning a stock in a particular period of time. You can categorize the news into good news versus bad news. And then you can check whether stocks with good news goes up and stock with bad news goes down. Right? That would be a test of the theory we just talked about. All right. So this is exactly what this paper did. They separate stocks into stocks with news and stocks with no news. They look at their average return. And then they separate the stocks into winning stocks and losing stocks. That's right. Yeah. So the winning stocks are stocks with good news, and losing stocks are stocks with bad news. And one thing very interesting is winning stocks, those are stocks with good news. Oh, sorry, I got it wrong. Sorry, got it wrong. It's not the way that is worked. So they separate. So the winning stocks are stocks that have been doing well. So that's the moment. So they have been doing well in the past. Losing stocks are stocks that have been doing poorly in the past. And then they look into whether they have news or not. That's what this paper is doing. So stocks that have been doing well continues to do well regardless of whether there's news or not. Okay, so you see that the average difference in return between stocks that have news and stocks that have no news is the difference is very small. As long as they are doing well in the past, they keep doing well regardless of whether they are on the headlines or not, and all the p-stacks are not significant. But for losing stocks, if they get on the news, they do a lot worse. So you see that the average difference in return is very high, and the t-stacks are already significant. So this is very interesting because it appears that if you're doing well, news, whether you're on the news does not matter. People know that you're doing well. But if you're doing poorly, then if you get on the news, it does a lot worse. How would you interpret this result? If a stock is doing well, doesn't matter they get on the news. They still do well. If the stock is doing badly, if they get on the news, they do a lot worse. In fact, especially if you look closely at the actual numbers, if for a stock that has been doing badly in the past, their future return is not particularly low, right? They are actually positive. They're actually positive and statistically significant. But they get continue to get negative returns if they get on the news. So there are different possible interpretations. One thing is if the losing stocks are not getting on the news, chances are nothing really bad is continuing to happen to them, right? So they are not on the news anymore. So these stocks might be doing bad. So the things are getting better for them. So they're not getting on the news. Whereas for those that are doing badly and they still get on the news, probably something really bad happened. It's also possible that it's a salience effect, right? Not every investors are aware of how bad a particular stock might be doing. And once you get on the news, then it spreads everywhere and people rush to sell. Right? Also remember that back when we talk about prospect theory, investors generally are reluctant to sell losing stocks. That's the disposition effect. In absence of any particular news, that's probably going to take effect. But if there is some really bad news, then maybe that's enough to convince yourself to sell, right? If there's no news, you might still be able to convince yourself, well, it might go back up, or you might, there's no particular reason for you to sell right now. But if there's a news saying, oops, sorry, our performance is going to be even poorer next year, then there's a very strong reason to sell. So that's another possibility. So stocks that have been doing badly does even worse when there is bad news, when they are on the news. Okay, so as you see, in many of these papers we talk about, there's a very, very practical focus, right? When you're doing a portfolio testing exercise, the strategy can readily be translated into an actual trading strategy. And that does happen. A lot of empirical finance academic researchers switch their roles between being a portfolio manager and a professor. Typically, they rotate around quite often. So, because the empirical research in finance have a lot of practical applications. So if we have a simple model like CAPM in mind, a profitable trade is to find stocks that have positive alpha, profit unexplained by the model. With more complex model, we might be able to explain away with more systematic variation in profit. So profitable trade would become less and less dependent on finding alpha. So John Cochrane, which is a very famous financial economist, and he was the president of the American Finance Association, so it's the biggest association of financial economists. So in his AFA presidential address, he has the following quote. He's quoting himself. I tried telling a hedge fund manager, you don't have alpha, since seeking alpha is a very common concept, right? There's a website called Seeking Alpha, which is a news website for financial news website. You don't have alpha. Your return can be replicated with a value growth, momentum, currency, and term carry and short volatility strategy. Is that exotic beta is my alpha. I understand those systematic factors and know how to trade them. My clients don't. And he has a point. He might not be. Is he quoting himself? I don't remember. I have to check his address. Whether maybe he's not quoting himself. He's actually quoting someone else. I think he might be quoting someone else. Right. But the idea is, what hedge funds, what an investment professional calls an alpha, you can very well call it exotic beta. There is whatever you think is abnormal return in the market very likely has some underlying factor that you can systematically generate, right? Value effect is an example. Small cap effect is an example. Momentum is an example. And then there are things that we won't be able to talk about. Currency, term carry, so these are all factors that you can systematically generalize. When they are factors, then you can calculate a beta for them. It's not the CAPM beta, so that's why it's an exotic beta. It's some weird beta. But you can systematically generate factors that capture those effects. And they would be able to explain what you would think is abnormal return. Right? The difference between someone who studied empirical finance and someone who doesn't is that you understand that what people believe is abnormal return is actually systematic. You can generalize. and you know how to trade with them. Whereas the clients that rely on you to invest for them wouldn't. So you would just explain to them, oh yeah, and we are generating alpha for you. We're generating some no return over market. But you know, as someone who has studied empirical finance, that these are actually systematic factors that you can trade on. All right, so I've already mentioned that last week, so you can do it